Thanks for joining me again today, folks. Today we're going to talk about, I hear a lot of you guys have concerns about the debt ceiling. So let's go over what the debt ceiling, let's just go over kind of the results of what's going on with that. Because what we're going to talk about today is all the economic news today that's happening today that's going to affect stock market, mortgage rates, cryptocurrencies, bond yields, the whole slew. So I got an idea for you guys. If you're out there and you're really concerned about the debt ceiling, because it's going to play, if this goes all the way to D-Day, it's going to play some havoc in the markets. It will be resolved. It might take a month or two or three where there's halts on payments and everything. That completely disrupts the system. So what you guys might want to do is look to lock in your rates now. And even if you haven't found a house, we offer a program that's called Lock and Shop. So you guys can lock in rates now while you're shopping for a house. The nice thing about using us, I'm going to go over the economic news in a minute, but the reason why a lot of people use us is we're a mortgage broker. I'm a federally chartered bank, which gives us the opportunity to help you guys all throughout the country, but we're also one of the country's largest brokerages. So here's how that benefits you guys. Let's say, for example, you find a house right now, and we lock in your rate. Well, the debt ceiling is going to have some havoc on mortgage rates. It's going to increase those rates artificially for the next, until this thing gets resolved. And then after that, once it gets resolved, things will settle down, rates will come down a little bit. So how you can prepare yourself for all this is lock in now with us, and then we'll monitor your rates and we'll monitor your progress through this whole system. And then if we see mortgage rates basically plummet by the time you close, we can always move you to another lender. That's the opportunities that you have with dealing with a bank and a broker all wrapped in one. So let's get over to it. You saw just the headlines pop up. Home builder sentiment pulls out of negative territory for the first time in nearly a year. So home builders, they're saying, okay, we're going to start maybe building some houses. This is perfect timing for this, folks, because why? I keep saying we need more homes being built. You guys might disagree and say, well, no, there's not enough homes. Well, look at it this way. We have over 1 million people right now in modifications. They're struggling on their mortgages. That they're not going to put those houses on the market because they're sitting on probably a pretty good interest rate. And the banks are going to work with them to drive down those payments even more affordable on those houses. So anybody in a mortgage modification right now is probably going to stay in that mortgage modification, not sell their homes. Then you have people with existing homes with mortgage rates, and I know I talk about this every day, but it is showing, it's showing that it's fact. That people like us aren't putting our houses on the market unless we have to sell, which I don't have to sell, and millions of other people like me don't have to sell. So how do we get the supply up? Well, you have to build a lot of stuff. But today, in today's topic, we're going to talk about the debt ceiling, interest rates, and then what we expect from the Federal Reserve. Are they going to keep increasing rates? So let's go over the topic today. Treasury yields rise as traders await clues of U.S. debt ceiling. That's what I'm talking about. You're going to see rates in general going higher right now because of the uncertainty of things. So please check out our Lock and Shop. And at the end of this video, I'll give you information on how to reach out to us to take care of or get involved with that program. So let's go over to the economic news for today and see what else is in the news that might be playing a little havoc on the market or might be actually calming the markets. Well, we only have one thing in today, and that's retail sales. So we look at this and say, okay, are consumers still out there buying and buying and buying in a robust manner? Well, it's starting to subside, folks, and this is what we've been talking about. I said, here's what's going to happen. A lot of people are going to be forced back to work, which we're actually seeing that right now because we don't see the jobs numbers plummeting, and people are going to run out of money, and they're going to stop shopping, and inflation's going to, you guys are going to say, oh, miraculously, inflation's going to come down, but no, energy prices are down huge. And mortgage rates for housing shelter, which is a third of the inflation numbers on the consumer level, are down substantially. So when all these numbers actually starting to get down to the Fed level, you're going to see inflation tumble really fast. So let's go over to this piece of the puzzle. Here's what I was talking about. Consumer debt passes $17 trillion for the first time, despite what's going on with mortgages. So people aren't loading up on mortgages. So where this debt coming from? Well, it's not, fortunately or unfortunately, it's not coming from car loans either. It's coming from consumer credit cards. So people are spending and spending and spending. But the nice reprieve here is we're starting to see retail sales numbers basically plummeting. The expectations for this quarter, month over month, was for retail sales to increase 0.8%. It was half of that at 0.4. So people are starting to cut back on their spending. So that's proven there. Retail sales right here. Retail sales rose 0.4% in April, less than expected as consumers struggle with inflation. So all this ties together with exactly what I'm saying, okay? The next thing is we want to see what in the world is going on right now with rates. So we look at here and say, okay, what does the Federal Reserve control? Well, they control one number. It's called the federal funds rate. And before you freak out on how, they're raising rates exponentially, well, yeah, we're seeing that's all over the place, but the Federal Reserve only controls that one piece of the puzzle, the federal funds rate. What is the federal funds rate? Well, actually, it's interbank lending. So let's say, for example, at the end of the day, a bank is deemed insolvent, like we've seen some of these banks recently. Well, they can go to other banks and get money lent to them overnight. What rate do they pay? Well, that's the rate they pay. This rate, a lot of people says, well, the Federal Reserve hasn't done enough yet. Guys, do you realize the federal funds rate last year about this time or a little bit before this time was zero? And now it's 5 to 5.25. Okay, so let's see what some projections are for the next meeting. Is the Federal Reserve going to raise rates? So what we do is we go over to this, and we don't guess. We never guess here on the channel. We go to the Chicago Mercantile Exchange. Okay, and what this is telling us right now, what is the likelihood that the Federal Reserve will change their target rate at the upcoming FOMC meeting? Okay, so here's the probability of this happening. So what I showed you right here is what is the federal funds rate? It's 5 to 5.25. Where are we? That's where we are right now. So here's the chart. So it's they're saying in June, the expectations, there's an 81% chance that we're going to stay at the 5 and 5.25. This just last week was zero. Okay, the 19%. It is now, 19%. I just said it. So the expectations now are getting a little bit more to the side that will they raise rates once again? I don't think with all the data that they're getting, they're not going to do that. So here's what the projections are for the next few meetings. Well, actually meetings all the way through 2024 is they're expecting them to stay where they are right now, right through here. And then from there, starting on the 9/20 of 2023 meeting, September, they're expected to start to reduce rates and bring it all the way down back to a tune of about 3.25 by 2024. So that's what's going on right there. Let's go see what's going on in the bond market. So this is the screen that I see on a daily basis, folks. You might ask why. Well, at the beginning of the video, I said I'm a mortgage advisor. So I really need to know what's going on with mortgage rates, mortgage programs, guidelines, and everything else. But on my screen, one of my computer screens each day, I show all the bond yields. You're seeing right here, the 10-year treasury. I put this up here because a lot of people think they need to follow the 10-year treasury to figure out what's going on with mortgage rates. Well, you don't. All you need to do is follow the mortgage bonds on Wall Street to figure out what's going on with mortgage rates. So what you really want to follow is the MBS market. We've shown that right here. It is telling us that it is down 9 ticks. This was down about 20 just a little bit ago. So you can see the greens through here. Well, you can't really see it. I got a green screen behind me, but the upticks are going up, 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 up. So you might say, oh my God, the rates are going up. No, what I want you to focus in on, this is a mortgage bond. And this is telling us what's happening to the price. Now, all I need you to know is what's going on with this price. If the price is going down, okay, you might say, woohoo, that's good news. No, when a price of a bond goes down, it pushes up its yields, its rates. So in this case, because it's a mortgage bond, it's pushing up rates, okay? The bigger this number, that means the bigger the adjustment. So a minus 0.09 isn't really going to do anything. So don't worry right now, folks. Mortgage rates are staying steady. Where are they? Well, here's the top 6 mortgage products people use when they're buying or refinancing a house. Now, these aren't my rates, folks. These are what's published by Mortgage News Daily on a daily basis. They do a fantastic job with this. They send out flyers to mortgage lenders all over the country, and there's thousands and thousands of them, and they respond. They say, though, if you had a consumer that's looking to buy a house, okay, and pay attention to the criteria because it's important. They're looking to buy their first home. It's going to be their primary home, a single family home. Okay. Those are criterias. Then they have a 740 credit score with 20% down. So they have all that criteria. What would the rate be? Well, that's the average rates in the country right now. So, folks, so if you're not putting as much money down, your rate's going to be a little bit higher. If your credit scores are not as high, well, your rate's going to be higher. So what I'm saying is basically these are the best rates that you're going to see. So I want you to see the trends of what's going on. Just since yesterday, within a 24-hour time frame, you see on the 30-year period right here, rates went up 1/8% yesterday. That's a big move. So that's why I say you might want to look into our shop, Lock-in Shop. It's a program that allows you to lock in today. Just all you need to do is give us a call up here, schedule an appointment down below, and just call us or apply online. Click right here. So what you're going to do is apply online. We're going to get back with you, get you pre-approved, and get you locked in. You're going to have up to 120 days to find that house while you're locked and shopping. So that's just one of the features that we have to help you guys navigate this home buying season. So without further ado, that is it. So if you like my video, I hope you do and find entertainment value in it. All I ask you to do is give me a thumbs up, and don't forget, hit that subscribe button down below. Take care, guys. See you tomorrow. Bye-bye.